Let me start with something that sounds small, almost irrelevant. President's Day. A quiet Monday, equity markets closed, lower liquidity, news cycle slows down. Commentators fill time with surface narratives. Most people treat it like a harmless pause, but markets don't pause, they rotate. When cash equities shut their doors, the dollar system doesn't go to sleep, it simply migrates, FX continues, futures trade electronically, funding desks keep rolling liabilities, repo agreements mature, swap exposures get recalculated, margin requirements update in the background, and when liquidity thins out, pressure doesn't disappear. It compresses. This is the part retail investors rarely see. During a forced closure, especially one in the United States, the global dollar machine keeps breathing offshore. Banks still need dollars. Corporates still hedge exposures. Hedge funds still manage leverage. Treasury futures continue pricing expectations. And when participation drops but risk remains, volatility becomes more sensitive. A small imbalance in a thin session can plant the seed for a violent repricing when full liquidity returns. That's why this week matters. When Tuesday opens, silver is not just reopening after a holiday. It is reopening after a compression event. And compression in leveraged systems does not resolve politely. It resolves directionally. Now here's the claim. If dollar funding tightened even modestly while the U.S. equity market was closed, and if Treasury yields shifted in a way that pressures leverage positioning, silver could break out hard. Not randomly, not magically, mechanically, because silver sits at a very specific intersection in the financial system. It is not purely monetary like gold, and it is not purely industrial like copper. It is both. Which means when liquidity shifts and trust shifts at the same time, silver amplifies the move. You need to understand what happens during a closure. Dealers reset books. Funding desks measure collateral usage. Risk managers recalculate VaR under lower liquidity assumptions. If Treasury futures move while cash markets are closed, basis relationships distort. If FX pairs move sharply, hedges adjust. If the dollar strengthens offshore, global borrowers scramble to source funding. And if yields rise while positioning is crowded long, convexity hedging begins quietly. That's the oxygen dynamic. Repo is oxygen. Collateral is oxygen. Short-term funding is oxygen. And when oxygen tightens, the system sells what it can and buys what it must. The first thing it buys in stress is dollars. Now think about silver in that context. Silver futures markets are heavily paper-driven. Large volumes roll forward without delivery. Most contracts settle financially. That works perfectly in calm conditions. But if funding stress appears, behavior changes. Traders who were comfortable rolling contracts suddenly think about margin. Leveraged players think about cash requirements. Physical holders think about removing inventory from exchanges. When behavior shifts, thin markets move violently. Here is where levels matter. Assume silver has been consolidating below a visible resistance zone. Let's say that zone sits between 24.80 and 25.30. This is where prior rallies failed. This is where short positioning likely built. This is where options gamma may be concentrated. If Tuesday's open pushes through that band with volume, forced buying can cascade. Why? Because above resistance, short sellers lose control of narrative. Their stops trigger. Dealers hedging short calls must buy futures. Momentum algorithms flip long, and in silver, liquidity above resistance is often thinner than people assume. If 25.30 breaks decisively, the next air pocket could sit near 26.20 to 26.50. Above that, 27 becomes magnet territory, and once 27 prints, psychology changes. At that point, the conversation shifts from range-bound to breakout confirmed. That shift alone can pull sideline capital back into the trade. But let's go deeper than technicals. What would cause that push? Watch the dollar index. If the dollar softens at Tuesday's open after showing strength during the closure, that tells you funding stress is being resolved through liquidity expectations. That's fuel for metals. If Treasury yields dip, especially real yields, that's even more fuel. Silver responds strongly when real yields decline because it has no yield of its own. Lower real yields reduce its opportunity cost. On the other hand, here's the paradox. Sometimes silver rallies even when the dollar rises. That confuses people. But it shouldn't. If dollar strength is being driven by global margin calls rather than domestic strength, the system may be entering stress. And in stress, investors move toward assets that don't require counterparty trust. Silver becomes a hybrid hedge, smaller than gold, more explosive. The most dangerous move would be this dollar volatility plus unstable yields plus thin reopening liquidity. That combination can create what professionals call a gap and go scenario. Price gaps higher on the open and doesn't fill. Shorts chase. Physical premiums widen. Futures curve adjusts. And what looked like a quiet holiday turns into a regime signal. This is not about hype. It's about structure. Over the past decade, markets have grown addicted to low volatility and abundant liquidity. Treasury supply has expanded. Debt has accumulated. Leverage has layered quietly into basis trades and duration bets. When yields move unexpectedly, mechanical hedging flows amplify the move. That amplification transmits into volatility across asset classes, and metals are downstream of that volatility. Silver's market depth is far thinner than equities or major FX pairs. It doesn't require trillions to move price meaningfully. It requires imbalance at the margin. And after a compressed holiday session, imbalance is more likely to reveal itself quickly. Let's talk positioning. If managed money is moderately short or underweight silver, a break above 25.30 could force repositioning. If open interest expanded during consolidation, that means energy has built inside the coil. Coils release violently, always, and here is the psychological layer. President's Day symbolizes political stability, a celebration of institutional continuity. If right after that holiday the market signals instability in funding, yields, or currency, the contrast becomes powerful. Investors who were comfortable suddenly feel dissonance. That dissonance creates urgency. Urgency moves silver. Now imagine Tuesday opens and silver tests 25.30 within the first hour. Volume expands. Dollar slips. Yields tick down. Momentum ignites. Shorts cover. Retail jumps in late. Physical dealers raise premiums slightly. Social media amplifies the move. The feedback loop tightens. At that point the question shifts from, will it break out? To, how far does it run before resistance? Above 27, the structure becomes even more interesting. Because above that zone, many longer-term traders view 28.50 to 29 as the gateway to a full retest of the 30 psychological barrier. And 30 in silver is not just a number, it is memory, it is prior cycle highs, it is where narratives flip from trade to regime. But let's stay disciplined. A breakout must hold. If Tuesday spikes above resistance but closes back below 24.80, that's a bull trap. That signals liquidity noise rather than structural shift, so the daily close matters. The weekly close matters even more. Watch the close. Always. What you are watching this week is not random post-holiday volatility. It is a potential revelation of stress that built quietly while attention was low. If funding conditions tightened, if treasury auctions showed weakness recently, if cross-currency bases widened, those are early tremors. Silver reacts to tremors before earthquakes become obvious. Because silver is small enough to move first. This is the moment retail often misreads. They chase headlines. They miss plumbing. Professionals watch plumbing. They watch repo rates. They watch yield tails at auction. They watch swap spreads. If those indicators flash instability, metals respond before equity investors fully understand why. So here is the clean takeaway. If 25.30 breaks with conviction and holds, momentum can accelerate toward 26.50 quickly. If 27 breaks, structural breakout discussion begins. If price fails below resistance, patience is required. Tuesday is not about magic, it is about compression resolving. And the only question that matters is whether you are watching a simple technical breakout, or the first visible crack in a funding regime that was assumed stable. Now step back from the chart for a moment and look at the machinery underneath it. Because silver does not break out in isolation. It breaks out when something else loses balance. And the something else, almost always, is the price of money. The bond market is the spine of the system. It decides what capital costs. It decides what risk is worth. It decides whether leverage is rewarded or punished. For years, that spine has been held in a carefully managed alignment. Yields suppressed when growth slowed. Liquidity injected when volatility rose. Confidence maintained through repetition. But repetition is not the same thing as stability. It is habit. And habits eventually collide with arithmetic. Here is the uncomfortable truth. The system today requires large and continuous treasury issuance. Debt must roll. Auctions must clear. Dealers must intermediate. Foreign buyers must participate. And if they hesitate, yields adjust upward to attract them. That adjustment is not cosmetic. It tightens everything. When yields rise for the wrong reason, meaning not because growth is accelerating, but because supply is overwhelming demand, term premium expands. That term premium is the market's way of saying, I need extra compensation for uncertainty. And uncertainty is the enemy of leverage. Now connect that to Tuesday. If during the holiday window Treasury futures softened or yields edged higher, leveraged players who are long duration feel pressure. If real yields tick upward, metals feel headwind. But here is the twist. If yields rise too fast, the system itself becomes unstable. Mortgage hedgers adjust, duration hedgers sell, risk models reduce exposure, volatility rises. And when volatility rises, safe, haven demand can appear even if yields are elevated. This is why silver can move in what looks like contradiction. It is not reacting to one variable. It is reacting to stress. Imagine this sequence. Treasury yields rise into supply. Dollar strengthens as global borrowers scramble for funding. Equity futures wobble because discount rates are no longer benign. Repo funding tightens slightly because collateral demand increases. None of this makes front-page headlines. But the structure shifts. Now imagine policymakers hint at easing or liquidity support to calm the move. The dollar stalls. Yields pause. Real yields soften. That pivot is explosive for metals, because silver is forward-looking. It senses the moment when tightening collides with political limits, and political limits are closer than markets admit. High rates are painful. They pressure housing. They pressure refinancing. They pressure government budgets themselves. At some point, sustained tightness becomes politically unacceptable. Markets know this. That's why every tightening cycle eventually gives way to accommodation. The debate is timing, not direction. If Tuesday's action suggests that the system cannot tolerate further tightening, silver doesn't need a perfect macro backdrop. It needs a hint that real yields will struggle to rise sustainably. That hint alone can trigger positioning shifts. Now let's talk physical reality. Silver inventories on exchanges fluctuate. Registered stocks move in and out. Most days, nobody cares. But during periods of stress, delivery demand increases. If futures holders request delivery rather than roll forward, inventory tightens. If retail coin demand rises because investors distrust financial assets, premiums widen. Paper markets function smoothly when trust is high. They strain when trust wavers. If you see silver futures breaking resistance at the same time physical premiums rise, that is not noise. That is alignment between paper and physical demand. And alignment is powerful. Above 25.30, momentum algorithms engage. Above 26.50, discretionary traders who waited for confirmation enter. Above 27, narrative shifts to breakout cycle. Each level reduces the pool of willing sellers. Each level increases the urgency of buyers who waited too long. This is where moves accelerate, but discipline matters. If Tuesday opens strong yet fails to hold above resistance by the close, the market is signaling that funding stress has not translated into sustained demand. That would mean the move was positioning, driven rather than structural, and positioning squeezes fade if not supported by deeper flows. So watch the close. Watch the dollar's behavior relative to yields. If yields fall and the dollar weakens, metals have a clean tailwind. If yields rise but volatility spikes and equities wobble, metals may still catch a safety bid. If both dollar and yields surge calmly, silver likely stalls. It is about interaction, not isolation. And now the larger question. Is this a trade or a regime shift? A trade is technical. It respects ranges. It fades extremes. It reacts to headlines. A regime shift is structural. It changes how funding behaves. It alters the relationship between bonds and equities. It distorts currency flows. It forces repricing across asset classes. Regime shifts begin quietly. They begin when auctions clear less comfortably, when bid-to-cover ratios slip, when dealer inventories swell, when swap spreads behave strangely, when repo rates tick higher unexpectedly. These are not dramatic events. They are whispers. Silver listens to whispers. Because silver thrives when confidence erodes gradually. It does not wait for panic. It anticipates it. If this week marks the beginning of renewed funding strain, silver's breakout will not be a one-day event. It will be the first leg of repricing trust. If instead liquidity remains ample and auctions clear smoothly, then any spike above resistance will likely settle back into range. So here is the verdict. President's Day did not reduce risk. It compressed it. Tuesday is the release valve. The exact levels matter because they mark where positioning flips from control to chase. 25.30 is the trigger zone. 26.50 is acceleration. 27 is narrative shift. Above that, the path toward 28.50 and potentially 30 becomes visible. But do not trade headlines. Trade structure. Watch yields. Watch the dollar. Watch volatility. Watch the close. If silver breaks and holds above resistance while funding indicators show strain, you are not watching noise. You are watching the market price a shift in confidence. And confidence, once cracked, does not repair overnight. So when Tuesday opens and price moves hard, ask yourself carefully, is this just another breakout inside a comfortable system? Or is the system itself beginning to tighten in ways that make hard assets the scoreboard of trust? That answer will determine whether this is a fast trade or the start of something much larger.